and thank you for joining the BNY Mellon webcast series. My name is Jeff Stokes, and I'm the Orlando team leader and client strategist with BNY Mellon Wealth Management. I'm co-hosting today's program with attorney Gary Forster, managing partner at the law firm of Forster Bowman. On behalf of both of our firms, we thank you for participating in today's virtual presentation. Today's webcast is a timely discussion around two key themes. The first, featuring my colleague Jeff Mortimer, will provide insights into what events are driving the current market and share BNY Mellon's best thinking about what to consider now when investing during an election year. At this time, I'd like to invite my co-host, Gary Forster, to tell us about the second part of our program. Gary, I'll turn it over to you.
Thanks so much, Jeff. Hello, everyone. Thanks for attending. We think this is a very quick but very informative seminar. As Jeff mentioned, this is Gary Forster with Forster Bowman. We're a corporate and tax boutique in the Orlando area doing domestic and corporate, domestic and international corporate and tax work, a lot of estate planning, health law, asset protection, and some related litigation. The pandemic itself basically presents us with some interesting opportunities in terms of devaluation. Due to lower business valuations and asset valuations in general, assets can be removed from the estate and gift tax net at a low value. That allows us an opportunity to get assets out of the estate tax at a kind of a on sale price. That accompanied with the idea that these assets are going to probably rebound in value fairly quickly. When they rebound and recover, they'll be outside the estate tax, which is really kind of a double benefit. The seminar is about that opportunity and really the urgency that may be potentially created by a change in the government, in a presidential administration, in estate planning laws, which could potentially decrease our ability to get assets out. In, for instance, the likelihood that our unified credit could fall substantially. Right now, we can push a huge amount of assets out really for free. Plus, on top of this unified credit, the free amount, we can get this valuation. Whereas, you know, if the government changes, we really could be facing a much smaller freebie unified estate and gift tax credit. And that creates even further urgency to the window of planning opportunity. With that, I'll turn it back over to Jeff. He's got some technology tips for the seminar. Go ahead, Jeff.
Thank you, Gary. I'd like to share a few housekeeping items before we start the presentation. If you have questions for any of our presenters, we will be addressing those in the latter part of our program. Please submit your question by clicking the Ask a Question tab located below the presentation. If you encounter an audio issue, use the Click Here for Help link. In order to maximize streaming efficiency, we recommend you use today's webcast using Google Chrome. Please close all open applications on your computer or smartphone while viewing this webcast. A copy of today's deck is available and can be retrieved using the Attachments tab. If you have additional questions not addressed today, please reach out to your BNY Mellon or Forster Bowman contact, and we will respond to your questions in a timely fashion. Now let's jump right into it. I'd like to introduce, and I'm thrilled to introduce my colleague Jeff Mortimer, who's one of the most sought-after speakers with more than 25 years of experience in financial services. Jeff is the Director of Investment Strategy for BNY Mellon Wealth Management. In his role, he leads a team that sets capital market expectations and is responsible for making asset allocation recommendations. Jeff is a national speaker on issues of investment strategy, the financial markets, and the economy. Some of you may have already seen Jeff in the media on outlets such as Barron's, Fortune, Bloomberg, and CNBC, or heard him personally at one of our local events. Jeff, I'll turn the floor over to you.
Jeff, thanks very much. A lot of Jeffs on one line. I was told also that the name Jeff is not really used anymore, so you can tell a person's age just by the fact that they are named Jeff. Let's dive into the investment and economic outlook. Again, I want to offer some perspective about sort of all that is going on. Many questions from clients recently continue to focus on the election, the strong rebound in the stock market, and the perceived disconnect between the stock market and the overall economy. What the heck is the stock market doing when the economy seems to be struggling so badly? Main Street seems to be struggling so badly. How can those two be so disconnected? And finally, I get a lot of questions. I'm not a virologist or an epidemiologist, but I certainly get a lot of questions on the COVID-19 and what may be priced into markets. So let's touch on some of those as I go through a few slides in sort of rapid fire, but I just wanted to show you kind of what was on my mind. Let's look at the strength of the market itself. Believe it or not, we bottomed in the financial crisis in March of 2009, and had a very substantial rally off of that low. This performance off of the March 23rd, 2020 low has been just as impressive. These are very strong signs. We must listen to markets when they react this strongly because they are their own forward indicator. Remember that markets are a discounting mechanism for the overall economy and earnings growth. And when they launch off of a bottom like that, you must pay them heed. They are trying to tell you about what 2021 and 2022 may look like, both from a disease perspective, an economic growth perspective. Certainly, we came off a significant trough as we fell in a waterfall format, some 35% on the S&P in a few short weeks. So we have fully recovered from that and then some. Certainly the NASDAQ has done much better than that. Some stocks, of course, have lagged. But the market is also in here separating future winners from losers. Not only those companies that survived COVID-19, but may actually go on to thrive in the new environment. My belief really was that COVID-19 was not really a change agent, but much more of an accelerant. So think about it that we are all sitting here today in 2023. That's really how you have to think about what the market is trying to do, trying to figure out what companies benefited from consumer spending, which moved online, right? From telemedicine, from all of these things that were in process of changing, but COVID-19 really pushed a lot of those things probably years forward. And the market has to grasp all of that and discount a future which may bring those future states sooner than they would have happened without COVID-19. Let's go to the next page. Market leaders. This is from the March 23rd low. You can see on the left-hand side of this page growth stocks. So these are companies which are growing their revenues. Think about them as very strong income statements. So strong growth of revenues, strong growth of earnings. Value stocks are more strong balance sheet companies, and the market is clear in what it is favoring. It is favoring companies that have had the ability to grow their earnings even in a time of economic decline, and it is rewarding those companies substantially. Whenever growth becomes scarce, whenever growth of earnings becomes scarce, which it has done during COVID-19, any scarce asset, of course, rises in price. That trait rises in price, and that is in fact what has happened. It's not so much small versus large. You can see on the right-hand side of the page. It doesn't matter the size of your company. It's whether or not you're growing your income statement, you're rewarded. And if you're not, you are relative. You're still up, of course, but relatively you are lagging significantly those companies which were able to grow revenues during this period of time. Let's go to the next page. Stocks in an uptrend. has changed slightly. September so far has been a down month, especially at the beginning. There's been some recovery that's going on the last couple of days. But this really shows you, this page, a broadening of the stock market. So while growth stocks have done better, the market continues to broaden out, taking a lot of these companies with it. This is a very good sign, a healthy sign to a market that has moved so much higher off of the low. You want it next to begin to expand, and it's beginning to do that. Even the rotation that has begun to take place in September, to me, is a very good sign to take some of that froth off of some of those growth companies and place it back in companies which are maybe more substantial growers or will grow at least decently in a post-COVID-19 world. That may be also what the market is beginning to do. These are healthy rotations. So I continue to like what I see in the market even in spite of these pullbacks. Let's go to the next page. Cash on the sidelines is huge. $4.5 trillion sits on the sidelines in the market, and you can see the spike that took place because of COVID-19 on the far right-hand side of this page. Many investors panicked, pulled money out of stocks, bonds, whatever they could find, and threw it into the money market funds. The Fed then came along and said, okay, money market funds, no yield, right? I'm not going to pay you anything, right? This is the opposite of growth investing. It's when everybody wants something, the price of it, of course, plummets, right? When there's so much supply of anything that you don't have to pay any money for it. So think about that as short-term rates. So you're not making any money on your cash in your portfolio. And this is sort of on purpose. Some of that money has begun to leak back out, as you can see the far right-hand side of the page, a little bit of a fishhook, as people have taken that money and begun to place it outside. But we are nowhere near where we were pre-COVID levels. Let's go to the next page. Company buybacks, those disappeared during COVID-19, and fortunately or unfortunately have begun to come back. And this is supportive of stock markets through time. And so it's very interesting, again, not only cash on the sidelines, but companies that have begun to buy back their stock. These are both supportive of prices during pullbacks. So it's just, again, something you should keep in mind, how there are these support mechanisms within the market itself that continue to play a role of buying dips. So a market, these are traits of resiliency potentially in a market because of cash on the sidelines and companies beginning to buy back their own stock. Let's go to the next page. Economic update, certainly many talk of a V-shaped recovery, and here are some Vs. On the upper two panels, you can clearly see a V-shape in both of these. Home sales have gone crazy in the suburbs. Again, people sort of moving out of cities and more tightly compacted areas, more densely settled. And ISM manufacturing has almost returned to levels that were pre-COVID, believe it or not. The bottom panels, a little bit less robust. Certainly consumer confidence continues to suffer a bit, and this is more deeply tied to retail sales and Main Street. And you can see jobless claims on the lower left also spiking and then sort of plateauing down here at the million level or so. So even though the unemployment rate has come back to 8.4%, I think it will become sticky at this level, unfortunately. I think the easy job gains, that the people who are placed on furlough, were furloughed and have come back to work, those have all been counted. And I think now it's going to be tougher to continue to fill jobs. So I think you're going to have a lag, unfortunately, in the unemployment rate, and government may again have to step in to support workers who are displaced during COVID-19. Let's go to the next page. Fed's change in inflation policy. I don't want to get too wonky here. This is just a nice brief lunch meeting. But certainly the Fed changed to average inflation language. And what that means is that the Fed is now willing to let inflation run hot before they change monetary policy. And why that should be important to all of us is that the Fed changing policies to tight monetary policy, or taking money, taking the punch bowl away as it's known, the Fed has now claimed we will even do that later in the process. We are in no hurry to take any punch bowl away, and we'll even let the party go on longer than we previously would have. That is what Jerome Powell said a couple of weeks ago at the Fed's offsite. Okay, so it's very important to understand, because without the Fed sitting there taking the punch bowl away, it may allow this bull market to last longer and continue on further than many people believe. Let's go to the next page. Treasury yields, I won't spend a lot of time here. We all know a yield incredibly low, a very good time to be a borrower of money. And those of you that are clients or thinking of becoming clients of our firm, what some of our advice to you is to make sure that you have your right. Leverage is a double-edged sword. I understand that. But, man, when you can borrow at many times below 2% for long periods of time, and as long as you can make more than 2% on that investment, it becomes you have an ability to lever up. And as long as you can sort of pay back at any time, all these types of things, our clients don't have to borrow, right? They use borrowing as a tool in their toolbox in order to make tax payments to make sure that they can sort of carry on with their expenses, many times without disrupting their portfolios, especially in times of market volatility. Let's go to the next page. Correlation between Trump and new COVID cases. Again, we have clients that are Republicans and we have clients that are Democrats. If I do my job well on this call, you will not be able to tell what I am. I will talk policies, not politics. But here is what's happening in the markets. As the case of COVID go down, Trump's probability of winning election goes up. Look at how highly correlated those two are. And so it's interesting to note about the vaccine and perhaps rushing a vaccine, all those things before the election. The market is well aware of sort of what is transpiring. And again, the potential, I thought a very neat chart is Trump continues to gain a little bit in the polls. Biden's still a leader in most of the swing states that I've noticed, or in the polling data that I've witnessed, and also overall Biden is winning. And so some of that I think is priced into the market, but certainly Trump's gaining on him, and the better outcomes of COVID cases are certainly helping Trump's cause. Let's go to the next page. Swing states, this is just a couple of dates, July and then late August, and you can see that Trump, although Biden's still holding a lead, Trump has closed the gap in many of those swing states, but still Biden seen as, right, is the leader by, what would you say, an average of, 4 percentage points or so. So again, markets are well aware of this, but Trump continues to close the gap a bit. Let's go to the next page. Volatility. This is an interesting one because it really shows, these are futures curves of volatility, and it showed, look at the spike, and this is right around election day. So the market seems to be pricing in the high probability of a contested election is what this data show me. And perhaps the mail-in voting and the delays, I think the market is speaking that it's very unlikely that we have a president the day after the election day. I think the market sees this as maybe a prolonged month-and-a-half type issue where we may not know a winner for a while, and it may be, unfortunately, like a repeat or even perhaps worse of the year 2000, the Bush-Gore issue. Of course, Florida then, you guys are well aware of that one. Florida then deciding that, but having it go to the Supreme Court. So the market has probability baked in that unfortunately may happen again. Even The Economist, the magazine that I read religiously, this is produced out of the UK, of course. Their cover story this week is about our election. And I just read their article on it this morning. And again, they're also talking about that same probability of a contested result. Let's go to the next page. With all that said, those of you that have heard me present before, this is one chart. The charts that I've shown you prior to this one are all sort of hot off the presses. This one is 18 years old. So this is a mindset of mine, a philosophy of mine about how to interpret stock markets and it's the interaction between the economy and the stock market. And I drew this at my desk in 2002 in San Francisco, California. I have since spent most of my life trying to quantify this picture. And I've gone back, and 6 o'clocks are market bottoms, 12 o'clocks are market tops. Between 6s and 12s on the left-hand side of the page are market upswings, and between 12 and 6s on the right-hand side of this page are recessions or at least severe market corrections. I have spent 25 years mapping history. I've mapped every 6 o'clock going back to 1969, mapped every 12 o'clock going back to the same data. I've mapped every 7, every 9, and every 10 on the left-hand side of this page, and I've also mapped every 3 o'clock on the right-hand side of the page. So in general, over a 25-year period that it has taken me, I've mapped every 6, 7, 9, 10, 12, and 3. If I taught my 12th grade son the same mathematics and modeling techniques, he would also be able to tell you where we are right now, because I mapped, of course, up through last night. Where we are right now is a 9 o'clock. We are in a mid-cycle bull market. If you close your eyes and just looked at history without any emotion and mapped it to the current day, this market is behaving like we are in a mid-cycle bull market run. A new bull market, by the way. Not the same bull market that we left pre-COVID, but a new bull market that has started on March 24th of this year. So please be cognizant. I'm not bullish or bearish innately. I am trying to help our clients navigate market cycles. We were telling them to get into this stock market on March 24th. The actual market bottomed on March 23rd. The wheel missed the bottom by a day, and it helped us navigate. It's an input to our committee that I chair, and it helped us navigate and help clients throughout this COVID-19 process. So again, this is right. If it is a purely unemotional look at history, please look at it as a map, and that this market is behaving exactly like other historical markets when they are in a mid-cycle bull phase. Let's go to the last page. All this summarizes into our, affectionately known internally as our diamond chart. We are neutral in equities. Overall, we have a slight home field bias. U.S. large cap is a small overweight. We are slightly underweight in international assets, but please notice we are neutral equities. Our clients have fully participated in this recovery in the stock market. We were telling them to lean into and upgrade their portfolio during the waterfall, but never went to a below neutral weight in equities, believing that during the waterfall itself, it would probably turn out to be a better entry point than exit point. We are slightly underweight fixed income or bonds, especially U.S. Treasuries, as you can see. We do not like the interest rate risk that you would be taking in just owning Treasuries. So when you own bonds in your portfolio, please make sure they have yield in them, including high yield debt. We like diversifiers, those clients that allow us to do so. These provide diversification to equity portfolios. And again, we see volatility, especially up to and maybe through election day. So we like especially absolute return strategies in the portfolio to buffer equity volatility without having the interest rate sensitivity of bonds. So that's sort of our best advice that we are giving to current clients. Why don't I end here and turn it over to Gary, who will take you through the estate planning and other things that he mentioned at the beginning of this presentation. Gary, I'll turn it to you.
Thanks, Jeff. Great up-to-the-minute information. It's always very valuable. Nice to hear from you. I'm always impressed with that wheel also. I can see why it lasted so many years. I'd like to introduce my colleagues, Tom Shaw and Brian Page, both of which have significant estate planning backgrounds. I think you'll be very interested in their comments associated with both the opportunities created by COVID and the urgency potentially created by a change in the government. Attorney Tom Shaw will lead the presentation. Tom is board certified in wills, trusts, and estates and has over 30 years practice in the area. Along with domestic and international estate planning, which Brian Page and I work together on constantly. Brian also practices in domestic and international, federal and state controversies, trusts, and probate administration. Like me, Brian holds the LLM in taxation. Without further ado, Tom Shaw, let's get started.
Well, hello. Next slide, please. Yes, we're going to not cover every single slide. There's just not enough time, but you do have those materials in your presentations. If you go to the next slide, please. So from an estate planning perspective, a health crisis or a financial crisis, which we've just gone through, in the short run results in lower asset values and lower interest rates. These kind of crises provide planning opportunities to remove assets from your taxable estate at a reduced gift tax cost, and more likely to have greater appreciation pass on to your family as the assets recover in value. Now, besides the health and financial crisis, we also have an election coming up. An election requires clients to assess the impacts of changes in the law resulting from a change of control in the White House and in Congress. So a lot of our clients have been calling their stockbrokers, but I don't think many of them have realized they should be calling their attorneys, because there's an opportunity with these lower asset values and low interest rates to do some pretty significant estate tax planning. So next slide, please. I'm not going to go over the market because we've just been through that, but you know, the Dow Jones on January 31st was at 28,256. It bottomed out by almost 10,000 points in March, and by August 19th it recovered to 27,693. And the S&P had done something similar. So the question is what are the opportunities we have now? Well, for one thing, not all stock classes have recovered. And so there'll be some stocks that were affected by the pandemic more than others. I'm thinking of hotels and airlines, for example, and certain businesses that were not able to be in business during the pandemic. Also, the markets are not the economy. So it may be that you own assets in your stock portfolio that have gone down in value and have not recovered. And so there's still opportunities among your various asset classes. And certainly with privately held businesses, we've had clients who were basically forced to shut down for several months, and their asset value for their company is very low. And so that presents a unique opportunity to do some planning
and possibly very, very short term. You know,
yes.
You could get a very good valuation and take advantage of tremendous increases in value later on outside the estate.
That's right. And a lot of the techniques that we do hinge on whatever interest rate the IRS requires us to use. And right now that rate is very, very low. I mean, it's historically so low, it's almost looks like zero. Next slide. So what do we plan for if a Biden-Harris ticket wins and both houses of Congress are controlled by the Democratic Party? The big one that we're all focused on is the $11.58 million estate tax exemption. That's already scheduled to drop by half in 5 years, but it could drop sooner if Congress was looking for a source of funds to pay for different government expenditures. From what I've read, Joe Biden has proposed just letting that exemption drop by half in 2026. But there has been talk, and in the last election, Hillary Clinton had suggested dropping it to $3.5 million. So we could be facing a situation in the next couple of months where a state tax law passed in the new year, effective January 1st, could reduce that exemption dramatically. And so it's very possible in the next couple of months, because of the election, people should be focusing on whether they need to be using up their exemptions before they go away. The other thing is the step up in basis that we get when we apply the estate tax exemption, that has been proposed to go away. And so a lot of our planning, even where clients don't owe estate tax, is to figure out how to get step up in basis in their assets and avoid capital gains taxes. So if the step up in basis goes away and the exemption goes down, clients could be looking at significant estate taxes in the future and also significant capital gains taxes. And also, as part of the election, rates could go up. And so you're not only faced with less exemption against the tax, but you're also looking at higher rates when you do have to pay the tax. Next slide, please. So I want to talk about just a couple of things that could be done in the next couple of months as a way to hedge against what might happen in the election or what Congress might do in the new year. So one option is to fund a GRAT. It's called a Grantor retained annuity trust is the full name. And basically that's a trust where the client keeps the right to income for a set number of years, and then the remainder passes to children. And that's usually in further trust so that the children are protected from their own creditors and avoid estate tax on those assets as well. What the GRAT does, especially with asset values being low, is it leverages a gift that's already leveraged. So you think of the GRAT, when you make the gift, you're only making a gift to the remainder interest. So your gift is only the smaller portion, the remainder portion. If that asset is already devalued in price right now, and you gift it into the trust, you've gotten more asset than you would have gotten if the asset wasn't devalued. But because it's a remainder gift and not a full gift, there's an additional deduction in the total gift. So you double leverage how much is going out to the estate, or subject to estate tax. Now, you do have to outlive the term, so you want to be careful not to be in a high-risk category where you end up dying. But even there, if you did die early, you're no worse off than if you did nothing. Because if you do nothing, that asset's going to be in your estate as well as all the future appreciation. The other nice thing about the GRAT is you value the asset when you fund it. And then it pays the annuity payment. And it doesn't have to be revalued each year. So that you don't have the ongoing costs every year to revalue the asset. And that means the benefits of the lower values and interest rates that we're experiencing right now are locked in through the term of the GRAT. And if you do outlive the term, which of course we'd pick a term where you hopefully would, then that asset is completely outside your estate at a reduced gift tax cost, so you have more exemption for other techniques, and all that future appreciation, both from the market being down and from just future appreciation of the asset over time, is out of your estate. Next slide, please. Another concept that doesn't get a lot of talk is to possibly do a charitable lead annuity trust, sometimes called a CLAT. Now, this is not a charitable remainder trust. That's the one people are used to hearing about. In a charitable remainder trust, you retain an interest for your lifetime, and then the remainder passes to charity. This is the reverse. You're setting up a trust, you're transferring assets to it, you're giving a charity an income interest for a set number of years, and then the remainder passes back to your family, typically, or a trust for your family. And again, a trust is helpful because it can keep that out of their estate for estate tax purposes and protect them from their own creditors. So much like the GRAT, it's an annuity, so there's no ongoing valuations over the term of the CLAT. And you can even zero out the gift pretty easily now because of the low interest rates.
And you might want to go, Tom, into the purpose difference, the idea of when you would spend a minute maybe when you would do the GRAT and when you would do the CLAT. For instance, with the GRAT, we may have people with a large amount of either investment income or some kind of similar passive interest where they need a certain income every month, yet they're in a taxable estate situation where they could move a large asset into a GRAT and just retain the same income they would have kept otherwise that they require, yet this asset has been moved into the trust, and after the period of annuity ends, it's outside your estate. So you may not even require much of a lifestyle issue, and then go into why you might want to do the CLAT for the deduction.
Right, and that's a good explanation for where a GRAT can be very helpful because you do retain this income flow through the term for a set term, and also get some estate tax planning. With the CLAT, most typically you have some charitable intent, and so because whatever the term of the CLAT is, those benefits are going to charity. And it's a situation where you don't need the income. And so you're going to get a charitable deduction on the front end, but you don't need the income during the term. So next slide, please. Now this one is not a technique in the terms of setting up a trust, but it is important to remember to keep in mind annual exclusion gifts. which is a right any person has to make a gift valued up to $15,000 per person. So, you know, if you have a husband and wife and they have 2 kids and each of the kids has 2 kids, you can give, the husband and wife can each give $15,000 to each of those people. And that can end up being a lot of money out in 1 year. We sometimes use that when someone is real close to the estate tax exemption and they just need to stay underneath it so they're not subject to estate tax. But you also can fund those annual exclusion gifts with something besides cash. So you could use stock that has gone down in value, knowing that it's going to go back up in value. And so again, it's the same leveraging where you're using the reduced value to pack more assets into that $15,000 cap. And then if it's outright, there's no gift tax return. Next slide, please. The other thing you can do with assets that are devalued is you can fund existing irrevocable trust or create new irrevocable trusts. Again, packing undervalued assets that likely will appreciate in the future. Now, if you don't have any exemption left, or you're getting close to that, you might consider doing what's called an intentionally defective grantor trust, where you're actually making a sale of an asset, and so you don't have as much of a gift tax implication. You use much less of your exemption, but you still get the asset out of your estate. Similarly, you can make loans to your family and at least get assets that are producing income out of your estate, at least until the loans are repaid. Those loans also lock in the appreciation because you could be loaning out assets and be paid back in cash.
And the purposes would be, again, if on the sale, this is a client who has substantial assets who would sell it out to the trust and keep a payment under the note.
Right.
Yet
exactly.
the asset, the actual tree, he keeps the fruit, the income through the payment, like a grat, but the actual asset, which may grow substantially in value, is outside his estate, his or her estate, in the trust.
I also think it's important too, with the low interest rates right now, the ability if you do a sale to your defective grantor trust.
It's minor.
I mean, it's less than 1%, and with the market right now, that would be a great way to leverage that.
Yeah, that's a very good point. There's also on the slide they're talking about some other concepts. We won't go into all of those right now. But even for some older clients, depending on real estate values, if they're in a place where real estate values have gone down, that hasn't played out in the last few months. But if for that to happen, sometimes even a qualified personal residence trust, where again, they keep the right to stay in the house for a set term of years, and then the remainder ends up passing outside their estate. And then they even keep the right to lease the property for the rest of their lives. So again, getting assets out of their estate. Sometimes that works. Not typically in a low interest rate environment, but for older clients, that could work. If you could jump to slide 29, please. The other thing when we're looking at income tax rates going up, it makes sense to look at IRAs and do some planning with IRAs. And so, for example, you may want to consider having your IRA payable to a charitable remainder trust. And basically, the income that's built up inside that IRA won't be taxed. And that charitable remainder trust could pay a benefit to your family for their lifetime before the remainder goes to charity. The advantage of that is under the new rules for IRAs, you can only hold back beneficiary shares for 10 years. After 10 years, it has to be paid outright, whereas in the past, we used to set up trust where the IRA was payable over the person's lifetime. I think it's the next, could you go to the next slide, please? One more. Okay, well, there we are. And so that's something to take into consideration. The other thing is while clients are alive in this high interest rate environment or low interest rate environment, in an environment where we may have increases in income taxes, is to do a qualified charitable distribution, which if a person was 70 and a half on December 31, 2019, or 72, if they attain 72 after that date, they can make a $100,000 a year gift to a charity. Again, it counts toward the required minimum distribution, and if they don't need the money, it gets it out of their estate and avoids paying the higher income tax rates that we think may be coming. And then, as I said before, if you set up that CRT as an annuity trust, you don't have to value the assets every year. Obviously, if it's marketable securities, you could do a uni trust. The benefit of a uni trust is it tracks inflation. I know a lot of clients are concerned about inflation in the future. So that's something to keep in mind, is that if you do a uni trust, as the assets go up because inflation's going up, then the unit trust payment each year will go up as well. So we go to the next slide. Of course, no discussion that involves income tax rates. We can't leave out, consider converting a standard IRA to a Roth IRA. And again, the reason for that is that the assets in the in the IRA right now might be lower, so the income tax you pay on the conversion will be less. But in addition, if rates do climb as high as they look like they may go, if the election goes toward the Biden-Harris ticket, converting the Roth later, you'll have more income tax to pay. And then it says here on the slide, as it says, the IRA, when your beneficiaries inherit it, still are subject to the 10-year rule, so they'll still have to pull it out over 10 years. But because it's a Roth, they won't be paying income taxes on the future higher income tax environment. And then if we could jump to the caution slide. I just want to say I am encouraging clients to start doing some of these techniques now to get assets out of their estate, because even if there is no change in the administration or Congress, in the next 5 years, the exemption is going to be dropped by at least half. And it makes sense to use up that exemption that's going to drop before it does. And so I am encouraging people to start looking at assets, doing GRATs, doing QPERTs, doing charitable remainder trusts if they're charitable inclined, doing defective trusts, things that make sense for their situation and the cash flow that they need. But having said all that, we need to be careful not to say, oh, this is a great opportunity, low interest rates, low values, let's just do everything, and then end up with buyer's remorse later. So you do have to very cautiously assess your situation and then diversify the risk by the type of techniques you use, knowing, however, that any technique you use right now is going to help you before that 2026 deadline. The other cautions are, next slide please, we might just have gridlock in D.C. like we've had for, seems like decades now, and there may not be changes to the tax laws, and the economy might crash, and people might need money to live on. So that's why I say when we do these techniques, we look at the overall picture. We don't put everything in one basket. We try to diversify the risk and make sure that our clients still are able to live their lifestyle, but not have to worry about estate taxes for themselves. Gary, do you have anything else?
No, I think that was a great wrap-up, Tom. We really focus on these strategies. We offer really a nice overview to clients. We take in your information. We review issues we feel that may be outstanding with respect to at least your existing estate plan, but absolutely with respect to estate tax planning now. You've got a window now. Basically what Tom was referring to in terms of the urgency is in 2026 the estate tax is going to change anyway. It just may happen earlier than that, unless the law, for one reason or another changes, over the next few years. We appreciate the time you've provided us in this seminar. Very nice overview, Tom. Thanks, Brian. Thanks, Jeff. Thanks, Jeff Mortimer, also. And thank you for attending the webcast. We appreciate it.
Thanks, Jeff, Gary, Tom, and Brian for those really informative presentations. We'll now switch to the Q&A portion of the program, and we have a few questions in the queue. And as a reminder, click the Ask a Question tab to submit any additional questions. So the first question, we're going to go to Jeff Mortimer. Jeff, what does a Trump stock portfolio versus a Biden stock portfolio look like?
So I do not pick stocks for a living. So there are other consulting firms that have built those types of portfolios. And while you can imagine what each of the stocks or industries which will be represented in those portfolios, Trump may be more on defense, right? Those types of things. Biden might be more on green technology. I mean, just to name a few. And those portfolios, their performance as of late, as you can imagine, has very closely followed the polling data. And so Biden's portfolio has done relatively well to Trump's, but Trump's has made a slight comeback during, as I showed you, the COVID cases coming down and those types of things. So they're types of portfolios. The market is trying to figure out not only who will win, but sort of how you should be invested depending on who wins. I would also point out that who controls Congress is incredibly important for markets. If you have the Republicans control the Senate, and whether it be a Democrat or Republican president, markets have historically performed about the same. So the markets will not only be paying attention, of course, to who sits in the big chair in Washington, but who controls both houses of Congress. In this particular election, it looks like the Senate continues to be up for grabs potentially, and we'll have to see what the voters have in mind in the Senate. So that's, I guess, a short answer to a very complex question, but that's sort of what I've seen as I compare the two portfolios, and then some caveats that I'd offer up as far as pay attention to the Senate as well.
Thank you, Jeff. Next question is for Gary and team. If you have a taxable estate, wouldn't those assets have to get a step up? Otherwise, your appreciation is taxed at the estate level and again at the sale as capital gain.
Under current law, if an asset is exposed to the U.S. estate tax, then it will get a step up in basis under Section 1014. The Biden ticket has proposed the removal of the automatic step up in that area. So if that's the case, even if something is exposed to the estate tax, all that means is it's included in their taxable estate. If that law does pass, then there'll be a transfer basis, so there'll be attached to capital gains for the beneficiary who receives the asset.
So Brian, that was Brian, who we send all the hard questions to, by the way. Mm-hmm. So that's an excellent question, and raises a number of problems and changes in the way we approach the planning in general, because gifts, for instance, are transfer basis. So if the client gives away a large asset, the recipient of the asset takes the client's basis, not the fair market value. There is no step up. So there's always this give and take with respect to, should I give it now and the recipient receives the transferred basis, but all the appreciation during my life will be outside my taxable estate, or should I just wait and die with the asset and get the step up in basis? Well, if we take away the step up in basis, I mean that quandary goes away. So we really kind of go more into a gift transfer platform where we're really not waiting on anything anymore at that point.
Basically, double taxation then, because you're getting hit on both sides.
You might as well do it now.
Right.
You might as well do it now. Yeah. I just thought I'd add that.
Jeff, the next question's for you. What impact do you think a Biden victory will have on trade policy and tariffs?
Well, that's a tough one to know because certainly Biden and Trump are now talking very tough and trying to out-tough one another as far as what they think of China. But I've learned in my 30 years of watching political rhetoric that bark sometimes is worse than bite. From what Biden has done in the past, he's been softer on trade and tariffs, and so may not have the sort of the hard stand that Trump has. With that said, I will tell you that I think Trump, for better or for worse, really opened Pandora's box as far as China is concerned. And I think the pandemic did China no help. The Chinese brand has been hurt, and maybe has been hurt substantially in the world's view about how they handled COVID-19, how they hid data, how they were late in letting the world know what was transpiring within their borders. So I think, regardless of who is president, I think continued wrangling among countries, and especially the U.S. and China, is something that the market is getting used to. And like I said, I think it may change on the margin depending who is president, but I think it is something that the world will face for probably decades to come. Whenever the number two economy historically has tried to overtake the number one economy, the number one economy has not given up without a substantial fight. So I think what you see is sort of what you get. It may be handled in a more diplomatic fashion under a different administration and less over Twitter. But I think what we have seen as far as posturing and tariffs and demanding other countries play a much more fair game is something that is with us, is here to stay.
Thank you, Jeff. Next question for Gary. With the exception of capital gains and stepped up basis issues, what size estate should really be concerned, especially for a husband and wife with ABC trusts?
I think that one of the things that we're concerned with here would be the decrease in the unified credit. We know it's going to drop down in 5 years regardless, but if there's a change in administration in Congress, that amount could go away. There's also concerns about the marginal tax rate over time. If you park money in a trust and it's not being pushed out to the beneficiary with the compressed tax rates, you could see very, very high income tax rates. And then if the capital gains rates also, I know it says here except for those, but if the proposal I've seen now is that the Biden-Harris ticket wants to increase the capital gains rates up to 44%.
Make them income tax.
Basically.
Tax, yeah.
And plus you add the state income tax on top of that, it could be substantial.
I think that's true. I think the credit, the unified credit, is the issue. I mean, if the credit's going to drop off to around half, why not use it up? I mean, if it's someone who doesn't need the money, the principal especially, we can set up an annuity out and get the asset out of the estate, keep the income, and use up the credit. I think once the credit's gone, it may be another, 80, 90 years before it comes back again. You might as well use it.
Very good. And with that last question, I'd like to invite Gary back for some closing comments.
Oh, we appreciate you listening. We hope this was somewhat informative. We're Forster Bowman. We're available anytime. We were really honored to have the seminar with these national experts, Jeff Mortimer, Jeff Stokes, who is a tremendous resource on the financial side, basically locally, has been a great resource to our firm as well. Thanks so much for inviting us.